Welcome, options traders. This is the FinSights weekly preview. As you can see, I've got the S&P 500 monthly chart up. This is going to be an informal video. There's no webcam. There's nothing like that. I've got Jake. He's admin in the group as well. If you want to say something, Jake.
How's it going? I'm sure you're all quarantined and not doing much.
Yeah. So I didn't make any weekly preview last week, probably because I was losing my mind, just like most of the rest of the financial world. So I want to start this off by having an Alan Greenspan quote. Now, I personally despise the Federal Reserve. I don't think a private entity should have so much power, but I love this quote by Greenspan. It's, we can guarantee cash benefits as far out and at whatever size you like, but we cannot guarantee their purchasing power. And I think that fits what we're doing right now with the talks of bailouts, the talks of the people's bailout, where anyone with an income below $75,000 is going to get a $1,000 check in the mail. You can't just step in a bucket and pull yourself up by the handle. It's not how an economy works, and that's why socialism will never work. So now that we've got that out of the way, obviously we're in unprecedented territories. Businesses are shutting down. Airports are shutting down.
Companies are folding.
There's a hedge fund from Chicago that blew up. I don't remember.
Clearing firm, Ronin Capital.
Yeah, Ronin Capital blew up. I've seen hedge funds sending out emails asking for more cash to buy the dip, which, in my opinion, I feel like if you're a hedge fund, you should probably have some cash because your whole purpose is to prevent the downside. Clearly that is not happening. So again, unprecedented times. So we've got this S&P 500 monthly chart up. This goes back to 1996. And we can see that we've had our primary trends here. We've got this one for the tech bubble before it broke, and then eventually led us all the way down to 768 as a low. And then we picked it back up before the global financial crisis. We made a peak of 1576. We broke the trend, and we fell back down to the lovely number of 666 before we picked it back up. And we've been above this most recent primary trend since that point in 2009. I do want to point out we just had our first close below it on the weekly chart. So this is something to pay attention to. We also hit limit down 3 minutes into the futures being open this morning. And I should go ahead and mention it is 8:15 p.m. March 22nd, 2020. All of this is educational purposes only. It's not a recommendation to buy or sell any stock. So as we're looking at this monthly chart, we can see that our indicators kind of warned us ahead of time. We had a bearish crossover on the MACD. We were oversold on the RSI, and we had a bearish break in the RSI that started back in the height of 2018. And then we've also, on the weekly chart, we were overbought in many of the other indicators there as well. But I will mention we are nearing our first major support level of 2100. I think that any sort of relief rally is going to come at this level. I honestly thought we would have seen it maybe a little sooner, maybe at this trend here. Maybe we would have bounced up to back to 3,000, and I'll go ahead and indicate that with an arrow here. I thought initially this is the kind of play we would be seeing before lower, but obviously we've just continued straight down as the pandemic gets worse and worse. I think the economy is starting to really see the effects of this thing, and longer term, we're looking at this 1,500 level. Obviously this depends on how soon we find a cure, how long this pandemic lasts, how long these business closures last. Something that can spur some optimism could send us right back up to the 3,000 level, depending on what kind of news comes out. So there is a lot of headline risk for either side if you're short or long. So we obviously don't have a fortune teller telling us which way this is going to go, but I will say that price discounts all information. I think we are pricing in maybe the worst case scenario as time goes on. So again, I think a lot of that has been priced in. We are down 30% from the highs. This is just unprecedented. The last time we had this kind of velocity was 1987. So we're looking at this 2100 level. Hopefully we'll see some sort of bounce, maybe back up to the 2600 level, and then maybe further downside. Again, all this depends on how long businesses are shut down. I know a lot of businesses are able to work from home. I myself have been sent home to work from home. Jake on the line with us, he's been sent home to work from home. There is a lot of benefit to that as far as being able to slow this virus down. It is a very serious deal. But there's, again, like I said, there's a lot of headline risk. The virus could also mutate, could become worse before it gets better. We just don't know. And again, I think the headline risk for longs and shorts is something to pay attention to, because you could blow up your account either way, whether you're long or short right here. So we're looking at this 2100 level. Maybe that'll be a good interim bounce to play. But longer term, unless we're coming up with a medical cure for this thing, I think after it runs its course, we're going to end up seeing 1500. And I think that's the general consensus between myself and some of the other admins. Maybe this 1800 level holds a little firmer than I think it will, but just be prepared for this. This 1500 level is just a little over 50% from the highs. So it's not unheard of. We dropped over 56% during the global financial crisis, and this is arguably just as unprecedented as that was. A lot of funds are very leveraged right now. There's a lot of deleveraging going on right now. We can look at the Shiller PE ratio. The Shiller PE is still at 21. Historically, that is very high as far as valuation goes. We want to see that closer to the 15, 16 level. And for that to happen, the market will have to drop another 30% for us to get back down to that level. And I think that's what will happen. I think the pandemic was the catalyst we needed to get down to that. We have this article. I wrote this back in February 2017. I noted that all bull markets must end badly, and this one is no different, and that has come to fruition. Now, if you read through this article, and I'll post this in the video notes, if you read through this, you can see that we did say that a Trump presidency was great for the economy, and China was the risk that we were paying attention to, because when China starts to devalue its currency, it destabilizes the global economy. It unfortunately, it's a reality we have to face now. Everything is linked globally. We've also had a crazy amount of quantitative easing and low interest rates contributing to this bubble. A great book to read about bubbles is Irrational Exuberance by Robert Shiller. It's actually how this PE ratio came about. Was Robert Shiller came up with a 10-year cyclically adjusted PE ratio, or also known as the CAPE ratio. And this is a great metric for evaluation in the market. And we can see we're still above where we were Black Monday. We're at levels we saw during the peak of the global financial crisis. So again, there's a lot of deleveraging that could still happen. Pull up the Fear and Greed Index for the CNN Fear Greed Index. We can see that we kind of have rounded out down here. I think the low hit was 2. Now that could play into this short-term bounce that we're looking at this 2100 level here. Now, again, with the way things have gone, we just pretty much shot straight down. Now, there's nothing that in the rule books that say that can't continue. We do have our circuit breakers at 7%, and was the other 13% and 20%. Now, those will help slow things down, and I do think that this will be prolonged, the rest of the downside, if there is more downside. But we're looking at a good 2 to 3 years of recovery at this point to get back to where we were at the peaks. 2 to 3 years minimum, and unless we find a cure for this thing, because there is a threat of this coming back in the fall and winter. And I don't know how many people have been addressing that, but that is something we need to pay attention to as especially options traders. I've seen a lot of comments about leap options. Again, the premium is just too high on these things. Do not be purchasing options. This is a seller's market right now.
If anything, sell options 6 months, a year out if you can.
And yeah, this is a seller's market for option traders. Call spreads on something like VXX might work. If you're trying to play the VIX here, we got the monthly VIX chart here. We can see that at the peak of 2008, during the global financial crisis, we hit a peak of 89.53. We hit a peak around 85 here most recently, and I do think that is going to hold. The 90 level is going to hold. So if you are looking to short the VIX, selling call spreads on VXX might be an option. No pun intended. So again, we'll look at the weekly S&P chart so you can see that break of the trend. We did close below this trend line here. That goes back to 2009. We've got this little trend line forming here around this 2100 level that we mentioned, and it does look like futures are going to open up down here. So this is one area to pay attention to. If we are going to have a bounce, it's going to be here. If we don't, we're going to see 1500, and mark my words, I think if there is going to be a bounce, it is going to be around this 2000 to 2100 level. We stood there in between 1800 to 2100 for about 3 years almost. So it's not a crazy thought to think that we'll have some sort of bounce back at the 2700 before further downside. Again, this also, everything is really relying on headline news at this point. You know, every day has been up or down 4, 5, 6, 7%. This is truly unprecedented for any trader. Unless you were alive during the Great Depression, you have not seen this kind of volatility. We are seeing weeks that are, you know, putting the global financial crisis to shame as far as volatility goes. We saw a lot of terrible days back then, but this is completely unprecedented, just the sheer pressure of the downside selling. But as we're looking at the weekly chart, we are oversold on the RSI. We look back in 2008 and 9 when we hit that extreme that marked a bottom. Again, we had our kind of warning up here when the RSI broke below 70. We did mention that in a previous video. If you're not following the Finsight's page on Facebook, we did mention that. We did actually go short here, but we sold out way too early. We did not think we were going to have this kind of downside. So one thing to look at is that the RSI is oversold. That could be marking a short-term bottom around 2100 or to 2000. You know, things are crazy right now, and I'm just going to be completely blunt this whole video, and I know this is informal the way we're doing this right now, but be careful. You could get your account destroyed whether you're long or short right now because of the volatility we're seeing. But right now we are looking at this 2100 level. Okay, I think we've got that pretty crystal clear for you guys. Now the daily chart is almost unusable. I will bring it up. We are oversold on the daily chart, but if you're looking at the MACD has not seen levels this low even during the global financial crisis. So again, we are at extreme lows right now. So take it for what it's worth. If you are trading with the 20 to 30 year time horizon, definitely you need to be going long or scaling into a position. You need to continue your dollar cost averaging. So one strategy, it's very basic if you're not a very good trader. I would just recommend to dollar cost average every month or quarter as you get paid, as you're in your accumulation phase, as you're in your working years, as you're accumulating your income, as you're saving for retirement. You need to be dollar cost averaging equal payments every month or every quarter. So that is one way to limit your risk. I think there was a statistic I saw, even if you bought the peak of, I'm going to completely screw this up, but if you bought at the peak of every year from 2000 to 2010, I think you would still be up. Now this is going off like 2017, but I think you would still be up 90%, I want to say. But anyway, the whole idea is to be in the market and not timing the market as your long-term investment strategy if you are not doing well trading. Okay, another thing I wanted to look at today is oil. I think oil below 30 is temporary, and oil below 20 is just an insane opportunity. You have to understand that a 55-gallon barrel of oil is now cheaper than 55 gallons of bottled water. So if that helps to put it into perspective, oil is a great opportunity. The world is not going to end because of this pandemic, and if it is, your money doesn't matter. Let's be honest. So oil right now is an opportunity of a lifetime. I think anything below 20 is gold, and I would be going out there with wheelbarrows, not buckets. As the saying goes, gold I would be a little more hesitant. We can see we've got some kind of support here at the 1450 to 1400 level. But gold has been run up already. We did call a gold bottom back in 2016. Obviously, that has played itself out. So paper gold, not necessarily the best investment right now, but oil right now, let's just call it liquid gold. And if you got the cash flow to get into it, I think anything below 20 is gold right now. Anything below 30 is temporary. There are worse things to worry about if oil does not go above 30 here in the next few months. That's not an opinion. That is just a fact. If oil stays below 30 for too long, you're going to see much worse economic situations than we currently have. Now, again, the valuation of the dollar could play into this, but if we're talking about $1 trillion bailouts here and there, we're going to see the value of the dollar decrease, which would in turn send the price of oil up as well. In a world where yield is hard to find, oil is your godsend at this point for maybe a year or two out if your time horizon is that far out. And then now that we've talked about the overall market and oil, we're going to go through some of these aristocrat stocks. I'm not going to go through every one. I will have a link that has all of these charts are public. You can go to it. You can look at it every day. I update it every day. And you can just kind of see what we're looking at. But I'm going to go through a few of these that I've brought up. I looked at their balance sheets and they look great, all things considering. Obviously, cash flow is going to be an issue in the future as businesses are shut down. But Aaron is one of those companies. It's a leasing company. It's kind of like a lease-own type thing. This is an aristocrat stocks, and all these stocks I'm going to show you are blue chip companies that have had really good dividend history. So you can see Aaron is down 80% from its high of 78. This is one of those long-term plays. If you're looking at your 10 to 20-year time horizon, this is one of those blue chip companies that are going to bring great value in the future. The only way I see this not playing out properly is if companies start to go bankrupt, and obviously if that starts to happen, we've got bigger things to worry about. So this is your long-term play here. Aaron, Aflac is another one I was looking at, down 50%. And I'm just going to kind of buzz through these real quick. We've got Archer Daniels Midland, they're down 40% or so. Let's see, we got a few financial corporations, Brown-Forman, a consumer staple. Now, if you know anything about me, I believe consumer staples are, as a lazy investor, so to say, I think investing in something like VDC, which is Vanguard's consumer staples, I think that is the way to go in the long run, because I will show you on a performance chart just the difference it makes when you are investing in consumer staples versus, say, the S&P 500 as a whole. Okay, so as I bring up this performance chart, I'm going to go all the way back as far as it'll let me. So the beginning of 2004 up until now, we can see consumer staples has outperformed the market by about 100%. And you can see how much better it performed during the global financial crisis here in 2009. So if you're looking for your lazy portfolio, consumer staples are the way to go. And Brown-Forman is one of those consumer staples that we look at. So we see here it's, again, 40% off the highs. I mean, all these stocks are trading at a huge discount. I think a lot of the downside is baked into a few of these companies. I do want to bring up Boeing because that is a hot company that people are looking at. Boeing does a lot more than make jet engines. They have a lot of technology, research and development, and military military contracts. And they have a lot more going on than you might think.
Airplanes.
And I don't think that the U.S. government is going to let a company like Boeing fail. So this is one of those other value plays where we're talking like 75% off the highs, off the most recent highs. So if you're a value investor, this is like being in a candy shop for you right now. Now I will disclose the way to value invest is, what's the easiest way to put this, Jake? You are buying falling knives when you are a value investor. You are buying when people are in full fear mode. So to that point, I say if you're not buying now, and you were buying, if you were buying 3 months ago, why are you not buying now?
Because you're an idiot.
I
mean, I'm just being blunt. I think that's the easiest way to put it.
Yeah. So obviously there is, like I've said with the S&P monthly chart, we could see another 30% downside. But as you're starting to scale back in, as you're starting to buy these dips, if not now, then when? We could see a cure come up in a week or two. We don't know what's going to happen. No one knows the future.
We could find an existing antiviral or something that works in combination with something else. We have no idea.
Exactly. So as a longer term play, I'm looking at C.H. Robinson. It's a trucking company. Did they really lose 40% of their value in a matter of 3 weeks? As we look at these other companies here, that's another good one here. HRL, that's a consumer staple. It does look like it actually rallied. I'm gonna have to delete this one out of here. But again, like these companies that have fallen 30-50% here in a matter of 3 weeks, Johnson & Johnson. Here's another one. Is Johnson & Johnson, the company, really worth 30% less than it was 3 weeks ago? I don't think so. I think we're pricing in the worst case scenario, which granted it may happen. We may see a scenario that is worse than any of us could have possibly imagined. I still think that 1500 level in the S&P is probably where we're headed. We're looking at Coke here. Coke is almost down 50%. Do you really think Coca-Cola is worth 45% less than what it was 3 weeks ago?
And I'm looking at Lockheed Martin, and it looks like it fell 55%. And
So-
442 to 291. I don't think it's worth any.
Yeah,
It's mind boggling, to be honest.
now,
Even General Dynamics,
yeah. So
household names.
as we're looking at these companies, either we are looking at something much worse than we could have anticipated, or we're starting to see the bottom. We're starting to see these individual companies are being traded at a discount finally. After all this time of being overvalued, we're finally seeing some sort of value in the market again. So this was, in a way, needed. But on top of that, if you are a long-term investor, why are you not taking advantage of this opportunity is my question. Now we did say in previous videos that going long up at the previous levels, I've got the Coke chart up here, but let me go ahead and bring up the S&P. We did say going long above the 3,200 level here, we did say that was high risk. And if you've been following us, we did. I'm not going to say we called the top, but we called the top. I don't like to brag too much, but we did call the top. But we just, if we are being completely transparent, we did not think we were going to go down 30% immediately. We did think we were going to come down to the 3,000 level, and we thought we would see a bounce, but clearly that was not the case. And
we didn't think we'd see Brexit levels.
And then this is way worse than Brexit.
Right. Price levels.
Yeah. We thought we would also see a bounce at 2,700 if you watched our last video. That also, we just blew right through it. Now, we did have a single day bounce of 10% off of that level, but then the following day we were down 7% again. So, as a human to human advice right now, don't panic. Things are bad right now, but we're resilient. The American economy is not going to fail in the long run. I think in 20 years, we're going to be looking at this as the opportunity of a lifetime. If you've got the cash on hand and you've got a 15 to 20 year time horizon, I would seriously start considering looking at these individual companies like Coke and Brown-Forman and some of these other aristocrat stocks specifically that are 50% off their highs, and take advantage of that. That is a rare situation that, if things do get better quickly, we could see recovery much quicker than 10 years from now. We could see it within a couple years. Now I am going to bring up a chart that needs to be used when you're considering your purchasing. So let me pull this up here. Now, as we're looking at the stock market here, we naturally want to buy when things are doing well. So we end up buying on this greed side of the line. But really, right now, we are in this margin of safety area. Yes, we can continue to go lower, and I even expect us to go lower. I don't think that we're going to find a cure within the next 2 weeks. You're asking a lot out of the science community that we've known about SARS since 2003, or we've known about it since before then. But that was the last epidemic we had of it, and if we haven't been able to develop what we needed by now, don't expect it to happen within 2 weeks. Now, obviously, things are a little more desperate now. So things could become figured out here in the next month or two. But, there's still a risk of this thing coming back this fall and winter. So the best thing you can do now is stay safe. Keep your eye on the long term of the market. The market does recover always over time. And so right now I think we're in this margin of safety right here, and all we're trying to do is mitigate risk, guys. That's the general idea of when I use charts. I'm you can't predict the future. I'm just trying to find the least. I'm trying to mitigate as much risk as possible by buying when stock is oversold. So, as you're looking at those companies like Coke and Brown-Forman and Aflac and all the other charts that I've got saved on here, just take it with a grain of salt. These are not, get rich quick trades, but we're starting to see levels that we saw back in 2008 and 9, and we could still push lower, but I'm optimistic about the resiliency of the American people, and I do think in the long run things are going to get much better. And it's like I said, as soon as we get a cure for this thing, things are going to skyrocket, just as the president has been saying in his in his briefings. So I hope this video brings some value to you. I guess the biggest takeaway here is watch this 2100 level in the S&P. Look at oil as it's below $30. As we said, it's as cheap as bottled water right now. And then look at these blue chip companies that are down 50% from their highs. I don't think that these companies are 50% less valuable in 3 weeks. Now, Jake, I don't know if you have anything to add.
Be careful.
Yeah,
that's about it. This is unprecedented.
I think it goes without saying. Exxon is again 60% from the highs. If Exxon goes under, I think you've got bigger stuff to worry about. So, this kind of wraps up the informal video. This is your weekly preview. I hope you find some value out of it, and I think I might keep these a little more informal so I can produce them a little easier here in the future. It does become a lot of work setting up a professional camera, setting up professional graphics. I do kind of like just talking and essentially ranting to you guys what I'm seeing and what Jake is seeing and what some of the other guys, some of our colleagues are seeing. So thanks for being a part of this Option Traders group. If you're not aware of me personally, my name's Justin. I run the Finsights by Justin Wilson Facebook page, as well as patreon.com/Finsights. That gives you exclusive access to some of the videos and posts I make as far as trading ideas go. So hopefully you found some value in this, and thanks for watching.